All right, welcome to this explainer. If you are seriously focused on your investments, you've probably realized by now that making money is really only half the battle. The other half, and let's be honest, often the much more complicated half, is figuring out what you actually get to take home. Today, we're going to completely demystify the complex life cycle of mutual fund taxation. We're going to break down the rules, decode the heavy jargon, and map out exactly how taxes impact your returns, literally from the moment you invest to the moment you cash out. Okay, let's dive into this. It is not how much you earn, but how much you keep after taxes that counts. That insight right there, straight from our source material, is basically the golden rule of investing. It establishes the real, tangible financial stakes of what we are talking about today. Think about it. You can pick the absolute best performing fund in the market, but if you aren't optimizing for the tax implications, you are just leaving your hard-earned money on the table. So, to understand this whole journey chronologically, here is our roadmap. We will cover 1. The pass-through principle, 2. The truth about dividends, 3. Decoding capital gains, 4. Hidden costs and setoffs, and 5. Tax saving with ELSS. Section 1. The pass-through principle. Who pays the tax? A mutual fund is what the financial world calls a pass-through vehicle, and here is the best way to think about it. Imagine a massive toll booth on a highway. Under Section 1023D of the Income Tax Act, the mutual fund itself is like a big bus that gets a free VIP pass right through that toll. Why? Because mutual funds are constituted as trusts specifically for the benefit of unit holders, so the fund's income is totally exempt from income tax. But the toll still has to be paid. The tax burden doesn't just disappear, it's simply passed directly through to the passengers on the bus, and that means you, the investor. You are the one who is ultimately responsible for the tax on the income generated. Section 2. The truth about dividends. Old versus new regime. And this brilliantly illustrates the massive shift that happened in how we are taxed. Back in the day, under the old regime, we had something called the dividend distribution tax, or DDT. The fund essentially paid the tax before giving you the dividend, which meant the dividend you received was tax-free in your hands. Pretty nice, right? But in February 2020, the rules completely changed. We shifted to the new regime, which is now known as IDCW, Income Distribution Cum Capital Withdrawal. Now, any dividend you receive is added directly to your personal taxable income for the year. So what does this mean for you? It means your dividend tax depends entirely on your personal income tax slab. If you're in a higher tax bracket, you are now paying way more tax on your dividends than you ever did under the old regime. Moving into Section 3, Decoding Capital Gains, Selling Your Units. Now, the tax landscape for mutual funds in India has seen some pretty radical changes, building up across recent history. First up, January 31st, 2018. This is the critical base point for the grandfathering clause, which actually brought long-term capital gains tax back to equity funds. Then, February 2020, which we literally just discussed, the removal of the dividend distribution tax. And finally, July 23, 2024, when a new union budget brought in entirely new capital gains tax rules and rates for units redeemed on or after this date. Staying hyper-aware of these dates is absolutely crucial to understanding exactly which rules apply to your specific portfolio. So the crucial point is this specific number, rupees 1.25 lakhs. If you're investing in equity-oriented mutual funds and you hold them for the long term, which means more than 12 months, your capital gains aren't taxed from the very first rupee. The government actually gives you a bit of a break. The first 1.25 lakhs of your long-term capital gain in a single financial year is completely tax-exempt. You only pay tax on the gains that exceed this threshold. It's a really vital piece of the puzzle when you're looking at tax optimization. Now, remember that 2018 date on our timeline, the introduction of the grandfathering clause? I know grandfathering clause sounds incredibly dense and academic, but let's break it down into 3 simple steps to see how it actually protects you from retrospective taxation. If you bought an equity fund before February 2018, here's exactly what you do. Step 1, note down your original purchase value. Step 2, look up the value of those exact units on January 31st, 2018. Step 3, you take the higher of those 2 numbers and you compare that against your final sale value. That difference is how you calculate your taxable gain. Let's put some real numbers to this to ground the theory in reality, using a scenario straight from the source material. Imagine you invested Rs 100,000 back in 2017. By January 31, 2018, that investment had grown to Rs 200,000. Now, let's say you sold it later for Rs 180,000. Normally, you'd think, hey, I made 80,000 profit from my original lakh, I definitely owe tax. But because of grandfathering, your base price is the higher of your purchase price or that 2018 value. The 2018 value of $200,000 is higher, and since you sold it for $180,000, which is actually less than $200,000, your taxable long-term capital gain is exactly zero. Pretty amazing, right? In scenario 2, if you sold it for, say, $220,000, your taxable gain is just the difference between the sale price and that 2018 base value, so only $20,000 is taxable. It's a brilliant protective mechanism once you understand the math. Section 4. Hidden costs and set-offs. The fine print. All right, let's talk about the Securities Transaction Tax, or STT. STT only hits you in very specific scenarios. When you purchase units of an equity-oriented mutual fund, the rate is nil. You don't pay a dime of STT. However, when you act as the seller, meaning when you redeem or switch your equity units, STT kicks in. For delivery-based sales of mutual fund units, it's 0.001%. It's a tiny, tiny percentage, sure, but it is a transactional friction that you absolutely must account for upon your exit. Now, on the flip side of the exit, we have the entrance fee. An amendment effective from July 1, 2020 introduced a stamp duty on mutual fund units. This is a levy of 0.005% applicable at the time of issue of units. And what's really vital to remember here is that this hits all inflows. It applies to your lump sum purchases, your monthly SIPs, systematic transfer plans, and, yep, even when you simply reinvest your dividends. You are allotted units only for the amount left over after the stamp duty is deducted. Now, nobody likes losing money, but let's provide a little bit of relief to this whole tax monster narrative. You can actually strategically use your capital losses to neutralize your gains through something called set-off rules. It works like this. A short-term capital loss is flexible. You can set it off against both short-term and long-term capital gains. But a long-term capital loss, that one is rigid. It can only be set off against a long-term capital gain. And crucially, there is a hard boundary here. You absolutely cannot use a capital loss from your mutual funds to offset income from other heads, like your monthly salary. No mixing and matching there. Section 5. Tax saving with ELSS. Reduce your burden. Now, what's really interesting about this slide is understanding the mechanics of the ELSS benefit. ELSS is an equity mutual fund that qualifies for tax deduction under Section 80C of the old tax regime, up to a maximum of 1.50 lakhs per year. But here is the catch, and it's a big one. It comes with a strict 3-year lock-in period. And I really want to emphasize the SIP trap here. If you invest via a systematic investment plan, the lock-in doesn't just apply to your whole portfolio from the date you started. No, every single individual SIP installment has its very own 3-year clock. So an installment you make today, it cannot be touched for exactly 3 years from today. Which brings up a critical nuance regarding how you set up your ELSS. The source text points out that most asset management companies actually stopped offering the dividend reinvestment option for ELSS. Wondering why? Well, because every single time a dividend was reinvested to buy new units, those newly purchased units would trigger a completely fresh 3-year lock-in period. It was an absolute administrative nightmare for investors trying to eventually clear out their portfolio. This is exactly why standard growth or just a simple dividend payout are the most practical paths for ELSS today. Wow, okay, we have journeyed all the way from the basic pass-through principle, navigated through the somewhat tricky waters of IDCW and grandfathered capital gains, uncovered the hidden STT and stamp duties, and explored tax-saving strategies. I know it's a lot to process, but honestly, understanding these gears is exactly what separates passive participants from focused, successful learners. So I want to leave you with this final provocative question. Based on everything we just decoded from the tax laws today, take a hard look at your own portfolio. Are your mutual fund investments truly optimized for the new tax regime? Thank you so much for joining me on this explainer.